Joining me now, Mervin Jebaraj. He is the director for the Center for Business and Economic Research at the University of Arkansas Walton College of Business. Economist Jebaraj, thank you for being with us. Always good to see you, my friend.
Good to be back.
Let's begin with, let's talk about some things happening just in economic circles nationally and where Arkansas kind of feels some of that in effect too. Next week, we will get a read on second quarter GDP. You do have a chance to look at some of the components that are going into that right now. People feel like we may officially be called into a recession after next week's GDP reading. But some elements of this don't feel like a recession. We've got decent job growth. We've got some productivity numbers that look pretty good. Why does it feel like a recession? Why does it not feel like a recession to you?
Well, I think, people might call it a technical recession, with 2 quarters of negative GDP. So the first quarter of this year, we had negative GDP reading. It's likely, not certain, that this second quarter reading will also be negative. But if you look at the components, both in the first quarter and what's likely making up the components of GDP in the second quarter, 3 key things indicate that we're really not in a recession. And those 3 things are: consumer spending is up. The consumer spending was up in the first quarter. Consumer spending was up in the second quarter. Business investment, so that's businesses going out and investing in things so that they can make more goods and services and sell them to consumers. That was up in the first quarter, is likely up in the second quarter as well. And then residential investment, another key component that's building houses, was up in the first quarter, maybe not as high in the second quarter given the high interest rates at this point. But nonetheless, with these 3 components being positive, it's not possible that we're in a recession when you have consumers going out and buying goods and services, businesses continuing to invest in their businesses. So while the GDP officially might read negative for 2 consecutive quarters, those are entirely driven by the amount we're importing from other countries, which is a drag from an accounting perspective on our GDP, and the amount of inventories that are being shed by businesses. So if you think back to last year, there was all this talk about supply chain troubles. We're still dealing with some of the supply chain troubles today, but businesses really shored up their inventories in the second half of last year. And so they're selling those goods to consumers at this point. So those are a drag, again, from an accounting perspective on GDP. So, whether or not the GDP reading at the end of next week is negative, we're not in a recession because it's not possible to be in a recession with consumer spending as high as it is, with job rate as good as it is. The unemployment rate remains at record lows. We have recovered almost all of our prime age employment. So that's, a key economic indicator when it comes to jobs is people between 25 and 54. About 80% of them are working, which is where we were before the COVID pandemic started. So you can't have consumer spending be up, unemployment be as low as it is, wages growing, not as fast as they were last year, and be in a recession. The obvious issue that we're all dealing with is inflation, but it's a separate matter than whether we're in a recession right now or not.
Well, let's talk about that, because I think a lot of people do kind of intertwine some of those definitions, for lack of a better way of saying it there. Inflation's just where your money doesn't go as far as it used to go here. And it doesn't necessarily mean that you're in a recession to have to be dealing with inflation. Maybe speak to that a little bit. Obviously, the feds are also raising these interest rates, which is cooling the housing market, which you talked to, but it doesn't seem to be cooling a lot of other things. What is this interest rate hike to slow down the economy? Do you think it is working to curb inflation?
I think to answer your last question first, maybe very slowly, but it's sort of a blunt tool to deal with inflation. So I think, first I've said that we're not in a recession, but I don't mean to discount that, households are feeling some amount of economic pain at this point. So while they might all be employed, a large number of them are employed and seeing wage gains, those wage gains are not keeping up with the pace of inflation that we're seeing in our economy right now. And so having said that, every household is now paying more for just about everything that they're purchasing, both goods and services. But if you look at the components of where we're getting inflation from, there was recently a study from the San Francisco Fed that looked at these components and separated them out into three categories: demand-driven inflation, that's you and I going out and buying goods and services, and that's driving up inflation; supply-driven inflation, where there isn't enough supply, which is causing prices to go up, and that's causing inflation; and then the middle part, which would be ambiguous. It could be supply, it could be demand as well. And so when we look at those three components, demand-driven inflation, that's the piece that the Federal Reserve can affect by raising interest rates. That accounts for well less than half of what we're seeing in inflation right now. So the Federal Reserve trying to cool the economy, trying to cool demand, trying to get us to stop buying as many goods and services, will only affect less than half of the inflation, maybe only about a third of the inflation. Most of the inflation that we currently see is supply driven. So if you think about higher gas prices, that supply has been affected both because of the pandemic. So coming out of the pandemic, a lot of gas production was cut back because nobody was consuming as much energy during the pandemic. These countries that are producing gasoline, including the United States, have not resumed production at those pre-pandemic levels yet. They're close, but they're not at pre-pandemic levels yet. The other side of this is that refinery capacity has been cut back. Again, a lot of them closed during the pandemic. And then refining companies decided not to invest in reopening those refineries because long-term, as we move towards greener fuels and energy efficiency, they forecast less demand for energy going forward. So again, they're not incentivized at this point to fix the refinery capacity in the short run because they think that this shortage of gasoline, which is primarily driven by the Russian invasion of Ukraine, is not going to persist into the future. So nobody's going to spend billions of dollars, investing in new refineries or fixing refineries if they don't expect this to pay out in 10, 15 years. So we're looking at the Federal Reserve pushing a very small lever, trying to affect demand-driven inflation, and that is not the major driver of inflation. So it really is up to the rest of the federal government, not the Federal Reserve, to address the supply chain issues, whether that's working on shipping, trucks, working on trying to convince gas producers here in the United States, as crazy as this might sound, providing future subsidies for fuel producers here in the United States. We did release gas from the Strategic Petroleum Reserve. You could reach a deal with gas producers to buy in the future gasoline from them at a certain price to refill the Strategic Petroleum Reserve. I don't think the public necessarily has a large appetite for giving gas companies that have record profits right now future subsidy. But if you do want to increase production in the short run, and if you do want to get gas prices down, which really, energy prices alone accounted for in the last month's inflation rate, 9.1% year over year. More than half of that inflation was driven by energy prices. And then a good chunk of the rest of it is driven by the pass-through of those energy prices, raising the cost of food and just about everything else as well. So, the short run, what the Federal Reserve can do is to try to make us consume less goods and services, but what the federal government can do to affect gas prices would require some rather unpopular subsidies. But if lower gas prices is what we need right now to likely avoid an recession here in the near future.
All right, let's go hyper local into Northwest Arkansas. This past week, we learned of the passing of Cameron Smith, one of the leaders in the supplier community in Northwest Arkansas. We also, this is the 60th anniversary of Walmart's first store opening. The Northwest Arkansas Business Journal, our sister publication, has a big cover story on that. Let's talk a little bit about Cameron Smith and the supplier community and Walmart, kind of all in one big question here. Explain to a lot of folks who may not know how influential Cameron Smith was in that supplier community and how influential that supplier community and Walmart are to that Northwest Arkansas economy.
Yeah, I mean, you think about Northwest Arkansas today and you see what's there today, the amount of jobs that there are, the nice amenities, and it's a great place to live and all of these things. But if you think back to when some of these companies started, so the big three companies like Walmart, Tyson, and JB Hunt started a long time ago in Northwest Arkansas, when Northwest Arkansas was not nearly this desirable place to live. We didn't really have a 4-lane road coming up to Northwest Arkansas for a long time either. Not a nice airport to fly into either. So if you think back to where Northwest Arkansas was, say, even in the 90s, when Walmart was a major retailer in this country, it was still hard to convince people to move here to take a Walmart job, and certainly hard to convince people to move here to take supplier community jobs. So at that time, before Cameron Smith got a start here in Northwest Arkansas, there were very few vendors. These are people that sell goods through Walmart based here in Northwest Arkansas. So most of the employment in the retail industry was Walmart itself, and then very little in the vendor community. And so Northwest Arkansas would not have had the phenomenal growth that it's seen in the 90s and in the 2000s had it not been for the growth both at Walmart, but also very importantly in the vendor community. And so at the time before Cameron Smith got his start here in Northwest Arkansas, I think there were maybe 40 to 50 vendors based here in Northwest Arkansas that had offices that were selling goods through Walmart. And today we have maybe up to 1,600 vendors here in Northwest Arkansas. And Cameron Smith was integral to bringing maybe up to a third of those vendors to Northwest Arkansas. So back in the 90s and early 2000s, it was, him and others that really convinced vendors that they needed to have a presence here to be able to sell more goods through Walmart, and got the existing vendor community to write testimonials to send to other vendors to try to convince them to come here. So today it's a lot easier to convince people to move to Northwest Arkansas. There are all these jobs, people have heard of it. All of these vendor communities there are from bigger vendor companies that have headquarters in bigger cities routinely send their people here, and it's not as much of a struggle. But back in the day when we didn't have the amenities and people didn't know what Northwest Arkansas was, it really took the hard work of people like Cameron Smith to try to grow the vendor community, which really growth in the vendors from 40 to 50 to all the way to 1,600 was what drove the economic growth in Northwest Arkansas, especially in the 90s and 2000s. And the 2010s, it's largely been everything else that's grown in Northwest Arkansas. But the previous 2 decades very much was driven by the growth at Walmart and the vendor community, and Cameron Smith played a huge role in that.
Appreciate those words on that. I think everybody needs to understand the context of just how influential he was. And he was a big personality, and he was a big community supporter on top of all of that. All right, he is Mervin Jebaraj, economist with the University of Arkansas Walton College of Business. As always, appreciate your insights. Thank you so much, Mervin.
Thank you.